Hey everyone, and welcome back to another Explainer. Today, we're popping the hood and taking a deep dive into the raw financial data of ZWS. We want to objectively uncover the true story behind its soaring stock price. Are these prices actually driven by genuine business fundamentals, or is the market kind of getting ahead of itself? Let's decode the numbers and find out.
To hook you right away, just look at this massive 10-year total return of over 420%. I mean, over a single decade, this kind of explosive triple-digit wealth creation is pretty rare. It immediately begs the question, what exactly is powering this company's engine? Because that is the kind of performance that absolutely commands serious attention.
But, getting to that massive long-term return hasn't exactly been a perfectly smooth ride. After a steep dip back in 2022, where the stock pulled back by over 41%, it roared back to life. It posted massive consecutive gains over the next 2 years, jumping by over 40% in 2023 and following that up with a 28% gain in 2024. That points to some serious recent momentum.
So, to avoid getting lost in all the financial noise, we're going to use a funnel approach today. We'll start with price and past performance, look under the hood at revenue, growth, and margins, check on their dividends and financial health, and finally, we'll determine the valuation and fair value.
All right, let's dive into Section 1, Price and Past Performance.
The recent surge here is just undeniable. We're sitting right now at $50.88, which is literally more than 51% higher than its 52-week low set just a year prior. Investors are clearly bidding this asset up with some incredible enthusiasm.
And get this, the momentum is only accelerating. A 5-year average annual return of almost 17% is already highly impressive, right? But then you see the 3-year jump to over 35%, and the trailing 12 months absolutely skyrocket to over 67%. That completely outpaces its historical baseline. The velocity of this growth is speeding up big time.
Moving right along to Section 2, Revenue, Growth, and Margins. Now we're looking inside the actual business engine room, and the raw fundamental output is fantastic. We're talking nearly $1.7 billion in trailing 12-month revenue, which filters down to $198 million in net income. But the real crown jewel here? A highly robust $316.6 million in free cash flow. That means, after all capital expenditures, the business is generating massive amounts of actual cash, which is the absolute lifeblood of any growing company.
But here's the real kicker. Bottom line growth. It's one thing to make money, but it's a whole different ballgame to grow your profits exponentially. Their net income has expanded at a massive compound annual growth rate of over 47% over the last 3 years. They aren't just selling more stuff, they're becoming phenomenally better at keeping the money they make. And the efficiency metrics back that up perfectly. Current net profit margins have jumped to 11%. That is a roughly 41% increase compared to their 3-year historical average. This kind of margin expansion is exactly what you want to see as an investor. It signals serious pricing power and excellent cost control.
Okay, let's shift gears to Section 3, Dividends and Financial Health.
Strong margins are awesome, but how safe is this company's balance sheet for the long haul? Well, these liquidity metrics tell a story of incredible financial safety. A current ratio over 3 means they can easily cover their short-term liabilities. But the real star of the show is that highly conservative debt-to-equity ratio of just 0.31. This company carries very little debt, operating from a position of profound financial strength.
And because they're operating from such a strong position, they can easily reward their shareholders. This setup offers an ultra-safe 33.9% dividend payout ratio. That means they're retaining the vast majority of their earnings to fuel future growth while still comfortably supporting 3 consecutive yearly dividend increases. It's just a highly sustainable, shareholder-friendly setup.
Which brings us to the climax of our explainer, Section 4, Valuation and Fair Value.
We've seen the phenomenal financial engine, but what is the actual price tag for all this excellence? Before we reveal the final numbers, we quickly need to understand discounted cash flow. Basically, it's an objective method that calculates exactly what a company's expected future cash generation is theoretically worth to us in today's dollars.
And we always pair that with a margin of safety. This is a critical indicator that objectively tells us, are we getting this stock at a discount, or is it priced for absolute perfection?
Well, here is where the math really collides with reality. You have this incredibly healthy underlying business trading at nearly $51, sporting a fairly high price-to-earnings ratio, but our calculated fair value, based strictly on those cash flows, is only $34. That means we're looking at a steep, negative margin of safety of almost 50%. The market is demanding a massive premium above what the underlying cash generation actually says the company's worth.
And the broader data totally confirms this reality. Nearly every major valuation metric right now, price to earnings, price to sales, price to book, they are all trading significantly higher than their 5-year historical averages. So mathematically speaking, despite being a phenomenal business, this is a very expensive asset at the moment.
So, the numbers paint a brilliantly clear picture. We're looking at a thriving, cash-generating machine with a bulletproof balance sheet. But the market already knows this, and they've priced the stock for perfection. So I'm going to leave you with this final provocative thought. At almost $51 a share, are you confidently paying for future growth, or are you simply buying into past perfection? Thanks so much for joining me for this explainer, and as always, keep letting the data guide your strategy.